I see all the young people, they're on sports gambling apps, they're on prediction markets, meme coins.
You're in a hole and you're about to dig it a lot deeper.
I think what people don't understand is it's a zero-sum game.
The world does not run on greed, it runs on envy.
If you're young and thinking about gambling on the market, then this episode is for you. We're here to talk about the actual wealth builders, dividend stocks that compound your wealth over time. This is Top Stocks, and we're here today not to talk about just one stock, but all of the stocks. Sports betting, prediction markets, meme stocks, meme coins, all these are surging in popularity, but it's not a way to build real wealth. Not just because it's difficult, but for fundamental reasons related to why investing works and gambling doesn't. I'm here at the Future Proof Conference in Miami Beach this week, and I've got a chance to talk to a great investor about the true path to wealth. Joining me today is David Bahnsen, the founder and CIO of the Bahnsen Group. He manages more than $9 billion in capital. I'm an investment analyst and economist with over 2 decades of experience, but more importantly, I have a huge, experienced research team at Stansberry Research that has done all kinds of incredible things. They've predicted the dot-com bubble and the financial crisis, recommended Berkshire Hathaway at $56, it's at $500 now, recommended Nvidia in 2016, Bitcoin in 2017. This is just what we do. David, thank you for joining me.
Thanks for having me.
Okay, I want to start with this because I'm a little concerned and a little worried. You have a piece about investing as a video game, and I see all the young people, they're on sports gambling apps, they're on prediction markets, meme coins, all this stuff, and I want to get them to stop, to be honest.
Yeah.
Do you have a pitch for them to stop gambling and start investing?
The problem with having a pitch to get people to stop is that it assumes that everyone's doing it for the same reason, and I don't think that's true. I think there's a Gen Z audience that is literally trying to play catch up. Like they believe financially they need to go do this aggressive speculative stuff because they feel so behind in terms of buying a home or paying off student debt or something like that. My pitch there would be you're in a hole and you're about to dig it a lot deeper.
Yeah.
That's a please stop moment. There's others who I really believe it's entertainment. And that's almost even worse because it gets sort of codified into the lifestyle and it becomes a very bad habit. It may not be birthed in this financial desperation, but when you mix up like when you go to Vegas, you know you're there just to have fun is the idea.
Yeah.
This other stuff, it has a semblance of seriousness to it, but then it's being conflated with entertainment, and that's the thing I'm most critical of.
Yeah, we've had lots of debates in our offices about this generation, and like you said, housing got so much more expensive. And there's a feeling, I still don't know if it's true, that like the ladder to the middle class is harder to climb, and that people need that big win, that big score right now in crypto or something to get to that next level. Do you think that ladder is gone?
Well, I know the ladder is not gone. I understand a lot of people feel that way. I also get confused sometimes if people are talking about a ladder to the middle class or a ladder from the middle class to something even better. Look, I try my best to be a student of human nature. I don't believe there's anything new under the sun. People have always felt like, oh, I have to do something big and quick. But I honestly believe that most of it is, look, I think that the generation is dealing with a very difficult housing affordability problem, and the student loan stuff is somewhat novel historically. But most of it is comparison to peer group. And that when people want to go hit a 10-bagger on some kind of speculative nonsense, they're comparing themselves to somebody else that had fortuitous timing in Bitcoin or something like that. Munger used to say before he passed, the world does not run on greed, it runs on envy. I think that a lot of that is what's going on here.
Yeah, and now you can see people's lifestyles on your phone, and it's probably not exactly how they're really living, and there's all this aspiration. You know, you sort of have a libertarian bent. I don't want to label you that unless it's fair.
I can see where you'd get that. I prefer the term conservative, but I'm certainly a limited government guy.
Okay, and I used to think, hey, look, people can do what they want. If they want to gamble, that's fine, right? As long as they're not hurting anybody else. But now when I see it on their phone with the addictive algorithms and they can do it in seconds, then I go, wow, this might actually be a bigger problem than I thought.
It's a tough one because whether you call it libertarian or not, there is a sense in which I do believe in adult agency and responsibility. And there's a lot of things people can do that are self-destructive that I think should be legal. The issue here is cultural, because people making bad decisions and learning from it, touching the stove is a very good way to not touch the stove anymore.
Yeah.
However, the thing that's going on right now, targeting college students, is even apart from the legality or otherwise, it is culturally everywhere. Yeah. It's at the bottom of your ESPN screen or whatnot. You know, I was a younger man at one point in time. I watched ESPN a lot, but we never had gambling for, you know, in every medium, let alone phones, social media, internet, streaming. It's a different issue now. And I think society can have a constructive debate about what the role of the state should be in that, but I certainly would agree culturally that it's a big problem, and I think that there has to be some sort of reckoning about the individual responsibility behind it.
Yeah, I kind of gave up sports when I had kids, and then to turn, you know, it kind of crept in. But if you turned off ESPN 10 years ago and turned it on today, it's like, how did this even happen? It's a whole different world.
Yeah, well, and I'm an older guy. I mean, from the 90s, you know, over like a 30-year period, it's even more foreign. Like a lot of this stuff revolves around sports betting now. And some of it's innocuous, you know, like fantasy football things at the office. It's a bonding moment. Like our company does a fantasy football thing, and everyone talks trash and has fun. But no, we're talking about something much deeper, and it's worked its way into investment markets as well.
Yes, and so I wanted to get to that because I think what people don't understand is it's a zero. The gambling, the prediction markets is a zero-sum game, right? And in fact, it's a less than zero game because you're trading against each other. The house takes a cut, and then on the sports gambling apps, they will shut you down if you're a good gambler, right? Because they're actually taking the other side. And so I feel like Wall Street got a reputation for being a casino in some cases, and they've lost the understanding of where the value creation comes from.
So here's where I'll push back. First of all, bad things are coming from Wall Street. Some of these products, they get originated from Wall Street, but that's different than saying that all that Wall Street's doing in the allocation of capital is bad. The fact of the matter is them going and facilitating day options in investing and some of these prediction market things and crypto things and 3x levered ETFs. These are all things I find deplorable. Yeah, Wall Street is, you know, financial companies are making these products, but it's less than 1/100th of 1% of what's actually happening. What they do fundamentally is value creation, or it wouldn't exist. They have to be getting capital to the companies, debt or equity, that are producing goods and services that meet the needs of humanity. That's what Wall Street is doing. But along the way, they find it irresistible to not create products that are going to find buyers.
Yeah.
And a good example, people could say that a regular unlevered ETF for Bitcoin was a perfectly conventional product, but a lot of the people that were most successful marketing and distributing them were people that loathed Bitcoin until the SEC allowed that to happen, and then they make the product available. Wall Street's going to do that. They're going to make products that people buy. But what I'd like to see is stuff that is totally zero sum, that has no benefit to society. I would like to see some companies say, you know what, let our competitors do it. It's not for us. We're going to focus better on our core competency, which is still getting capital to its most rational and efficient use.
Exactly. So I think and I agree with you, like what young people or these people attracted to gambling are missing is that at the heart of this, at the heart of a stock, there's a company. And that company is producing a good at one price, selling it at another, and they're creating value in the middle.
And if they're not, then they're not going to stay around very long.
Exactly. And I'm sure there are some companies that might do things that are, I don't know, a little unscrupulous. Maybe they're not creating a ton of value. Maybe, a predatory lender or something you could come up with. But on the whole, if a company has lasted, if it's producing a product, that's where the value comes from. And so you take the zero-sum gambling, it's not going to go anywhere. But when you're investing in these businesses with real value, that's where your investment returns come from over time.
I agree. And also I'd point out that I'm a big Michael Milken fan about the fact that capital is not the scarce resource. But for individuals, like across society, there's an ample amount of capital, and what we need are better ideas to put capital into. But for an individual, most people's individual capital is finite. And when someone is deploying to a wasteful zero-sum thing, that is dollars they're not in their own balance sheet deploying to things that are productive, that are yielding, This to me is the opportunity cost. Their waste and money compounds, and because of mortality, time is what it is. They're delaying starting the compounding machine of their own balance sheet.
Yeah. So I know you like dividend stocks. You have a newsletter called Dividend Cafe at the Bahnsen Group. And I love dividend stocks too. So if you had someone who was playing the gambling game, didn't know how to invest, and you wanted to say, no, look, here's how you get started, right? A lot of what we do on this show is talk to beginners.
Yeah.
What is kind of the message you would try to get to them to say, stop gambling, look at these dividend stocks? Because even young people in the stock market love AI stocks. They love the most speculative thing. How do you get them to have a more conservative view of investing? Because I believe that's in their own best interest.
Well, a lot of people believe dividend stocks are boring or bond-like, and so we always use the term dividend growth stocks because fundamentally we're not talking about buying stocks because they have a high dividend. We're talking about buying stocks because they are growing their dividend year over year. And when I say it to someone as you buy a stock right now and you're getting 4% on your money and you think 4% is very boring, you want to go get 50% 3 years in a row, get this NVIDIA return, that type of stuff. But then I say, what if I could tell you that in a certain period of time, you're going to be getting 100% on your money per year?
Yeah. Yield on cost.
That yield on cost idea. And that I don't need to get the lucky one, the NVIDIA, the kind of once in a generation type story, that it is math and it happens over and over again for what seems like very routine, boring value companies. The Johnson Johnsons, Coca-Cola's, Pepsi's, Procter Gamble's, Chevron's. I mean, these are blue chip names.
Yeah.
The people that bought it a certain period of time ago are getting 100% a year on their money. So I like to walk them through that idea, how you get there, and why it is that happens. It happens fundamentally because companies are producing goods and services and managing to a sort of social contract that they will continue being able to protect the free cash flow of the business in a way to honor that dividend commitment.
Okay, so you mentioned don't just buy the highest dividend yielders. That's a trap sometimes. Yeah. Sometimes you see a 10 or a 12% yield and you go, how can I lose? But you can, but do you have like a rule of thumb for like a cutoff level? How do you put that together?
Yeah, well, before you get there, you have to figure out how it got to be a 12 yield. So there's two ways it can happen. One is a company, let's say it's a $100 stock price and it's paying $4. So you have 4%, and then it grows to 6, they grow it to 8, they grow it to 12.
Yeah.
And somehow the stock price hasn't moved, that's unlikely, but growing the dividend from $4 to $12, that's one way to get a 12% yield. But the other way is that the stock price drops in half. So it had a 6% yield, but then the stock dropped in half, and now you say it's a 12% yield.
Much worse sign.
We call that an accidental high yielder. And that's not generally what we want. Now, you can have misunderstood stories. You can have dislocations. We have to do that analysis and make a determination. But most accidental high-yielding stocks are probably revealing a problem. When a company is growing into a higher dividend, that can be much more attractive. So each story is different, and we have to do bottom-up analysis.
And what do you think about stock buybacks? Is that as good as yield?
No, it is most certainly not. First of all, because they don't happen. Okay, they're announced, but they're not done, and you don't get to know when they're done. And something like 20% of S&P 500 companies that pay a dividend have cut them when things were going really bad during the financial crisis or COVID. Something like 80% stopped doing stock buybacks in those periods. So there's something just significantly more expendable about buybacks and less connected to that social contract I was talking about. But the other piece to it is if all these companies are returning cash to shareholders with stock buybacks, then why do they have more shares now than they did when they started doing billions of dollars of stock buybacks? Because it's not returning cash to shareholders, it's executive compensation. And it's one of the most dishonest things in our industry. That people that say we have a shareholder yield with stock buybacks should be forced to show. I mean, the information's there. But people have to go do the research to say, wait a second, how much really came back to me in the form of a stock buyback? Because if they have more shares after than before, then they didn't do a buyback. They replaced shares they issued generally for executive compensation.
Right, so you have to look at net buybacks and total share count over time.
That's right.
David and I were talking about share buybacks, which are an important part of how stock market returns work. You see, a company can buy back some of their own shares in the open market and make your ownership a little bit more valuable. But if they do it the wrong way, it's actually just to cover up executive compensation. So you have to understand how these things work. That's why Top Stocks is here. We're here to help everyday investors get more confident and build their wealth better in the stock market. And you can join us completely for free at topstocksletter.com. So when you see a company that's announcing big buybacks or doing stuff to you that looks like they're managing the stock price, right? Like they want to put out an announcement that's going to move the stock. Like, I don't know what your opinion of Elon Musk and Tesla is, just something where you're clearly talking to the market when you do this, as opposed to delivering results over time. Is that like a red flag, or is that just part of the game?
Look, it's part of the game. Elon, the problem with Elon is he's obviously delivered as well.
Yeah.
So he loves to try to speak to the market, but he also has delivered operating results. So there's certain cases out there where I guess people are exceptions to the rule. But as a general rule of thumb, it's companies in their 10Qs or in quarterly announcements saying we're doing this buyback authorization. And I think they should also say, from our last authorization, here's how much of it we actually did. Because sometimes they're not buying back all the stock they announce. So a dividend has an announcement date, a declaration date, and a payable date. And that money ends up in my checking account. They can't get it back. A buyback, they announce it, and we have no way of knowing, often for a year or 2 or 3, what they actually did. So buybacks have a place. First of all, I like companies doing buybacks to make up for new shares they're issuing. Between RSUs, incentive stock options, executive compensation, bonuses, I want companies giving equity to key people in the business. And doing buybacks to make up for it is anti-dilutive. I like that. But that's not shareholder yield. Dividends are things you can buy groceries with. Stock buybacks are not.
That's why they're so valuable. Speaking of value creation, and this kind of AI boom has left, there's not a lot of dividends there to be had. And there's a lot of questions of, there's a lot of spending now that's supposed to pay off later. Have you done a lot of work on whether you think that's going to add up in the end, or is?
Oh, I've done a ton of work on it. Let me first of all say that there is a lot of AI-oriented companies that are paying dividends. Otherwise, AI is going to be one of the biggest messes in history. Because if the Procter & Gamble's and Walmart's and Chevron's are not utilizing AA in the end, then every hyperscaler putting $1.5 trillion of capex into AI is about to lose a lot of money. There has to be companies that are benefiting from it, consumers and businesses.
It's not people with a chatbot subscription that's going to pay this thing off. It's got to be in
if every single person in the world had a monthly subscription to ChatGPT or whatnot, and ignoring the fact that there's 4 or 5 that compete with each other, if everyone in the world did it, 100% of revenue, assuming no cost over 5-10 years, doesn't make the money back. So no, it's not. The benefit has to come through greater efficiencies and productivity enhancements. So there is dividends connected to the AI space, but in the pick and shovel companies we think of as AI oriented, there often isn't. It's funny, we owned Broadcom since 2019. And we made 1,600% on it. They grew the dividend 14% per year, and we did end up selling it. People said, "Why are you selling it now? It's hotter than ever." I said, they become a great AI story. They have a 70x multiple. We owned it with an 18x, and they were growing the dividend. Now it's a sub 1% yield. And who knows what goes on from here, but the ownership thesis changed. And so we had to get out of the position, but they were a great dividend payer and grower. They just took off. And so
Broadcom shocked me the other day when I looked at their market cap, and they were crossed $1 trillion. And they're not, like, all the trillion and plus are household names that everybody knows about. And you know, investors know Broadcom, but I was like, wow, we've got $1 trillion companies that
they
most
weren't in
people
the top 100. And now they're in the top 10 in the S&P 500. That's crazy.
That is crazy. Okay, I want us to end with a lightning round. You've got a book called 250 Economic Truths.
There's no free lunch, 250 economic truths.
That's true. The subhead is what it really is. So I wanted to read you some ideas from that, and you tell us why it's an economic truth and why it's so important.
Okay.
Sound good? I'm gonna. We didn't bring a printer to the beach here in Miami, so I have to read off my phone. So excuse me. All right. This is von Mises. Under capitalism, the common man enjoys amenities in which ages gone by were unknown and therefore inaccessible even to the richest people. But of course, these motor cars, television sets, and refrigerators do not make a man happy. In the instant which he acquires them, he may feel happier than he did before. But as soon as some of his wishes are satisfied, new wishes spring up. Such is human nature. I bring this up. We're in the age of AI. Maybe it's an age of abundance, higher productivity. Everyone says, well, there'll be no jobs, right, if all these jobs go away. And that had me thinking about von Mises. What do you think?
Well, first of all, just the very examples he used, because he said that in the 1950s, it already shows how prescient he was. Who is sitting around saying today, oh, I live in the greatest age ever. I have a television and an air conditioner and a refrigerator.
Yeah.
We've been taking that for granted for 70 years and moved on to other technological advancements and amenities in life, which was his very point. The reason is our understanding of the human person and human nature. They identified humans have needs and wants. They get them met. They move on to something else. And that's part of the pioneering spirit of producing new and greater things, and the idea that humans are ever just going to say, we have now found everything we could ever want. There is always going to be greater advancements in some form to enhance our standard of living, and that's part of what makes a market.
And so when people say, well, there'll be an AI, there'll be no more jobs. And I think about, if you go back to 2000 and said, what will people be doing? And you have a social media manager, you couldn't have conceived of what these jobs would be.
No, and the notion, anyone who says AI is going to eliminate all the jobs is somebody who does not understand the human person. Mm-hmm. The notion that certain technological efficiencies will make the human need less and not be replaced with other components is so fallacious and totally contradicted by the testimony of history. Yeah. I freely admit that things are moving quickly and that there's a lot of unknowns as to how it unfolds. But the overwhelming confidence I have in the fact that AI will not replace the need for human labor is the fact that humans' wants and needs are infinite. Yeah. Therefore, the opportunities to produce goods and services for those needs is infinite.
And I feel like people want an answer about what's next, but in my study of technology, you can be 100% confident in your prediction there will be new needs and wants. You can't predict what they're going to be.
And you also can't predict how they're going to execute, what the business models are going to be. Mm-hmm. And I keep saying, go back to the late 90s with the internet and ignore the fact that the whole over-investment speculative boom resulted in this multi-trillion-dollar collapse with the dot-com bust. Put that aside. Every single prediction about the internet's revenue model was wrong.
It's just going to be you can read the newspaper online. That's what it was.
But then the companies ended up, a lot of them were extremely successful and new ones came and the internet has transformed our lives, just not in the way people knew in 1997. Yeah. And I can't think of an exception to that rule. This is a transformative, disruptive, innovative technology. I'm not AI bearish, but the idea that people know exactly what the business models will be that end up successfully monetizing AI, they know it right now. I'm sorry, they do not. Yet.
And so how do you approach that as an investor?
Well, I think you have to be humble, you have to be diversified, and you have to avoid manias. So if the company, like right now I'm very skeptical of the hyperscalers that can't give you an answer as to what the ROI is intended to be. I don't mind people taking risks, and I don't mind some of the risks not working out, but they don't have an answer as to how they're going to get ROI on some of these massive investments. Mm-hmm. Companies that previously their CapEx was 10 to 15% of their free cash flow, now they're spending over 100% of free cash flow. Wow. And those are the good ones. Those are your hyperscalers, your Googles, Microsofts, Metas. Then you look to some of the language model companies that are being given $800 billion valuations that do like $6 billion in annual revenue or something like that. And they have made $1.5 trillion of commitments of spending.
It's just not there.
The notion that they're going to get that money back, and it's all based on another problem, which is that everybody's going to win. Not everyone's going to win. The only way that this come close to penciling is if one company wins and the others all fail. So that's the hard part of your question, is how do you approach it as an investor? Do you want to pick the winners and losers right now between Anthropic and OpenAI and XAI, Grok, and of the major LLMs? Do you want to pick which one's going to end up winning? I don't.
And just in the last few weeks, it flipped from OpenAI to Anthropic.
We don't even know which ones the government's going to let stay alive
Exactly.
right now. It's a very precarious moment. So I tend to favor investing in the companies that'll end up being end users of the efficiency. And you know who has benefited from the cloud, from the internet, and will benefit from AI, and prior to that benefited from software and hardware? All of the companies in a portfolio like ours.
Yeah, it's everybody's playing on the same playing field, right? So if Johnson & Johnson and Merck all get more efficient, they'll have a better profit margin, but it's just going to be table stakes in a sense.
I agree. I agree. And I'm all for the notion of greater efficiencies from it. But the other piece I think people have to be very careful is assuming there's greater productivity coming. The internet made everyone's life a lot easier and better, but that's different than saying we produced more. AI doing something quicker and easier does not mean you're getting more of it. And I would be more favorable to an AI monetization path that is producing more than just merely doing something quicker. And that there's a distinction there in terms of output.
Okay. All right. I got another quote for you from your book. This one is in the similar vein. This is Thomas Babington Macaulay. And this is, in every age, everybody knows that up to his own time, progressive improvement has been taking place. Nobody seems to reckon on any improvement in the next generation. We cannot absolutely prove that those are in error who say society has reached a turning point, that we have seen our best days, but so said all who came before us with just as much apparent reason. On what principle is it that with nothing but improvement behind us, we are to expect nothing but deterioration before us? It seems like troubled times. It seems like people are worried about a lot these days, and they always are.
Yeah.
But it's always gotten better before.
I do a lot of public speaking, and if I'd use the little audience gimmick of asking people to raise their hand if they think that their kids will have a better life than they've had, nobody raises their hand.
Yeah.
And in the 80s, 90s, the optimism was such that everyone not only was going to end up having a better life, but they believed they were. Right now, no one does. And I think what the quote is highlighting is that maybe that lack of optimism is totally irrational. It's certainly not founded in history. So if all of a sudden things are about to get much worse, that would be unprecedented. Now, we have to distinguish, are we just simply talking about GDP growth? The debt to GDP ratios are more problematic than they've ever been. The student loan debt issue, housing affordability, there's problems. But historically, we found solutions. And as a Gen Xer, I'm 51 years old. I'm right in the middle of Gen X. And to me, I'm kind of torn between the baby boomers went out and created so much stuff, produced so many good services. The Gen Ys, and to a greater degree, the Gen Zs sometimes feel very pessimistic about things. And I'm sitting here as a Gen Xer trying to connect both elements of history and the psychology people are struggling with. I would tend to lean into the side of history that there are solutions, but the people that are going to end up benefiting the most are people who are going to play a role in creating the solutions.
And so I study economics, and you see poverty rates go down and life quality of life go up and all these things. But I have to admit, like when I do ask myself that question, is it going to be better for my children than me? I don't feel like it. Like I have to give myself a pep talk and be like, but look, this has happened. Do you feel that optimism, or are you in the same vein? Like, do you feel the
Let me put it this way.
threats?
I do, but I've achieved financial stability. I've raised kids. So I'm a middle-aged guy. If I was 30, I can understand. It's a different psychology. First of all, the other piece I would say to it is for that 25-year-old, 30-year-old trying to figure it out, there's so many people out there that are worried and wallowing and in that kind of paranoia. Go beat them.
Yeah.
Go take an optimistic attitude and compete with the people that are being held back by their own pathology, because I think that there is an incredible opportunity for those who are willing to put their head down and be optimistic. I don't want to belittle the fact that I don't think the housing affordability thing is fair. Like I think that the supply-demand imbalance that we have created societally through bad regulation, through bad execution of capital markets, through a baby boomer mentality, NIMBYism, there's a lot of blame to go around.
Yeah.
I think it's unfair, but every generation had certain things that are unfair they had to overcome, and not everyone in the generation ever has. Some people did, some people don't. So my advice to the younger folks is be on the side who does. Go overcome it.
I think the proper growth mindset is like reckless optimism. to go out and do something, you almost have to be a little crazy sometimes to do something that hasn't been done.
I agree.
All right. Let's see. I got one more for you here. This one is from Kevin Williamson. And so there's a section in your book on crony capitalism, which for people who don't know, is sort of the concept of the government encroaching more into economic activity, maybe capturing some of it for themselves. And so what Kevin Williamson says is, populist economic proposals are by nature a disorganized grab bag of rent-seeking and opportunism on the part of both politicians and their domestic business clients. These proposals lay a heavier governmental hand on economic activity, protecting politically sensitive businesses and industries, even if that means artificially reducing the overall standard of living, curtailing traditional economic rights, and violating the rule of law. It seems like this has been an issue for the last decade or so. How do you feel?
I think it's been an issue for 250 years.
It's always an issue.
Because this is what Adam Smith wrote about it in The Wealth of Nations in 1776, that when the businessman gets the ability to have government reinforce a moat around their business, they will take it every time. The only solution to avoiding it is to not empower government in a way that they can entrench and benefit one party over another. Government being in the business of picking winners and losers is anti-free market. By the way, it's anti-free market when a Republican does it or a Democrat does it. This is a totally 100%. Nonpartisan comment.
Yeah.
And so many young people that say post-crisis that they are anti-capitalism, when you talk to them, what they mean is they're anti-crony capitalism.
Yes, okay.
And I am as anti-crony capitalism as anyone could be. It isn't a free market way of being. It's an anti-free market approach. So I think that those of us who care about a free society have to resist cronyism with every ounce of breath in our bodies. States giving special benefits to companies to come to their town that are not being given to everyone, but are only being given to rich and powerful. So like when Amazon did their beauty contest a few years ago to say which city would give us the most perks and this and that. If you want low regulation, low zoning burdens, low tax burden for everybody, and you want to compete to bring a lot of businesses to your city, county, or state, I'm all for it. But if you're only offering it to one company that happens to be one of the 5 richest companies in the world, that's cronyism. And I think people on the right and left should stand up against it.
And that's not too disconnected from you're giving Amazon all these benefits, and at the same time, housing prices are high because you're not letting anyone build. It's the same. It's benefiting Amazon at the cost of people.
There's no question that market solutions exist to the housing issue. Like most issues of price, the solution is not in trying to get the price down, it's in trying to get supply up.
Yes.
And we could produce more housing stock if we want to do, but we have put a regulation apparatus in front of it that is all at once cultural, financial. There's a lot of people in communities that just go protest at city council whenever they want to build new housing stock. We also had cultural issues because people were getting married later, they're having kids later, that changed things, and houses are not like widgets where you could then turn on a switch and get the production up. And post-crisis, it was hard too because no capital was going into single family residence building for a number of years, and then we needed it, and it was hard to get the spigot back on. But yeah, you have to have a regulatory apparatus that favors more supply, and you can't pick winners and losers in doing that, and that will end up creating a much better equilibrium for the housing issue.
Yeah. Okay. So, not talking about a market call, not talking about where the S&P is going, but even in these troubled times, you are optimistic because of the human spirit. Is that fair?
Yes, it is. I'm always optimistic with the right timeline. Okay, as an investor, when people say, are you optimistic? That is not me saying I believe that stock prices will go up in the next month, quarter, or year. They are, by definition, public equities are long-term asset class, long-duration asset class, because you're making investment in earnings growth over a period of time. However, I would argue that not only does the human spirit drive profitable activities in public and private equity, but that these dividend growing companies are ones that have business models that are not reliant on multiple expansion. If somebody said, hey, the market's trading at 22 or 23 times earnings, are you optimistic right now? Is the question, am I optimistic that we're going to get to 26 times, to 30 times? I don't want to be optimistic in that. I don't want to be rooting for us to blow a bubble bigger. What I want to be rooting for are companies that are sensibly valued, that have strong free cash flow growth, that are sharing that more with us. So it changes the investment thesis from the sentiment, which I can't control, to the fundamental operating earnings, which we believe we can do research to understand and invest in.
All right. Well, David, that's a great place to leave it. Thanks for joining me.
Thanks so much.
Nothing we say today should be considered investment advice and should be used only for informational purposes.